Hello and welcome to another edition of the podcast. Another busy one today. We've got US Tech, we've got Unilever, we've got Rolls-Royce, we've got Berkshire Hathaway, and we've got results for next week. But first of all, Steve, busiest man in the team. How are the tech results? How's your
Well,
week
I mean,
been?
a real mixed bag, as you say, and it's been a real blistering week for tech watchers. But of course, after the market close on Wednesday was particularly interesting. You had Alphabet, Amazon, Meta, and Microsoft. God knows what those Wall Street analysts must have been doing. They must have been up all night. But it was a real mixed bag. And I think that the fundamental message was, beats across the board, but talk about escalating capex, and we talked about this in our preview of the big results. That what is capex going to be doing, and I think the market is they're basically saying we still buy the growth story, we're still happy to support you, but we're starting to get a little bit nervous about the scale of the capex. I mean, a couple of companies, particularly Meta, upped its capex budget for this year. We're now talking somewhere in the ballpark of $650 billion between just those four companies. That's the
Wow.
scale of it. Now, of course, the trickle down effect is that that money's going to find its way into someone's pockets. So again, those infrastructure companies we've been talking about ad nauseum, your Broadcom, your Nvidias, your Sandisk, blistering results. Again, they're doing really, really well because they're perceived to be massive beneficiaries of this huge amount of money flooding into the AI infrastructure sector. So let's talk briefly about Sandisk overnight last night. Knockout results. I mean, absolutely hit the ball out of the park. Let's just talk about the share price. So 300% year to date,
What?
3,000% plus over the last 12 months. Now, just take that in 3,000% over 1 year. That's amazing.
That's a
And of course,
30 bagger.
its valuation is just sky high now, but it's just growing so rapidly. And it's all about, this pent up demand for memory, 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 memory. And SanDisk is perceived by the market in general to be one of the huge winners. So, unbelievable performance. And of course, its shares went down because it's up 3,000% over 12 months.
That's nuts, isn't it? I mean, this is the interesting thing, right? I was just sort of doing some stats in the run up to this. S&P is up 10% in April. The Nasdaq is up 16% in
Yeah,
April, right? So those are the best months since we came out of the pandemic in 2020. The semiconductor SOX, the Philadelphia SOX index, is up 35, 36%. It's had its best month
yeah,
since the tech bubble in 2000.
yeah,
And there have only been, I was looking, there have only been 4 down days for the S&P and the Nasdaq in the last month. And those indices are at all-time highs. We're nowhere near all-time highs in the UK, but
yeah.
it's like it's tech earnings. It's like there's been a war, nobody told the market. Everybody's been looking at the
Yeah.
tech stocks. Um,
I mean, it's been
and
this
the
way
other
for a
thing,
long time, for many years, is that earnings have been really threadbare across any other sector that hasn't been related in some fashion to the
yeah.
technology boom. And I think it's really important to state for investors that you don't have to be in the semiconductors industry or in information hardware, whatever the sectors are. It's just about, does your business model drive technology and drive expansion?
Yeah,
Google, Alphabet, for example, is in the e-commerce space. So is Meta platforms because they make most of their money out of advertising. Let's face it, but they're perceived to be behind this massive shift to go digital, digital, digital. And we know as small business owners ourselves, the demand from governments to make tax digital. We're all
yeah.
sitting in a world where it's digital, 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 and that's got to be put somewhere. So data centers, data centers, data centers.
Yeah, well, we had a chat yesterday with James Brugger of Seraphim Space, and if he's right, Steve, then we'll have data centers in space. But
Yeah.
enough of that, James. Back to Earth. What have you been seeing this week in the real world economy, if you like?
Yeah, well, there were two positive updates from FTSE 100 constituents actually. So Rolls-Royce, another high flyer, they reported a strong start to the year and assured investors they can fully mitigate the current impact of the Middle East disruption on the business for the time being. The other one that stood out was Unilever. So we had a first quarter beat, a fresh 1.5 billion buyback. In terms of the quarter, it was emerging markets and the power brands that drove performance. Food was the laggard in terms of growth, so perhaps that does vindicate the decision to separate the food business and merge it with McCormick.
Mm.
Yeah, and then just lower down the market cap spectrum, IG Design sprang another surprise, another profit upgrade. And they've hired a new CEO from ex Unilever, actually, Gerald Kerr. So one to keep an eye on, albeit early days in the turnaround.
That's the second upgrade this year, isn't it, from those
It is,
guys?
yeah, yeah. It soared in February as well, I think, which we covered on the site.
Yeah. Unfortunately, I mean, I've been weighed down with the banks this week. Barclays, Lloyds, NatWest. Not bad results. Barclays market didn't like the provisions for bad loans, and you're starting to feel that people. I mean, banks, when you consider that these guys were the best performing stocks behind Rolls-Royce during 2024 and 2025. If you were underweight UK banks, you were nowhere basically. They've not had a very good year. They're all down 10% plus, and Barclays went down because people are worried about the quality of the loan book. Lloyds and NatWest are really interesting. Both these guys beat forecasts marginally, raised guidance. Lloyds for net interest margin and top line at NatWest. Yet both stocks went down. And the more I looked into this, I thought this isn't actually about the results, and it's not even about the outlook. This is about the banks lowering their scenarios. So they have base case, best case, worst case scenarios for the economy, and they provision accordingly. And both Lloyds and NatWest have basically said outlook for the economy is definitely getting worse. And of course, if you think about it, if you're a kind of macro investor, you go, well, banks are just giant cyclicals anyway. They behave the way the economy behaves. If the economy's looking to deteriorate, and we're not getting rate cuts. Now, we've heard from the Fed, we've heard from the Bank of England, and we've heard from the ECB this week. The Fed is no longer on an easing path. Bank of England said it's open to interest rate hikes, and so is the Fed. None of this is good for the economy, and actually it's not very good for markets either.
So I suppose from a retail investor point of view, I mean, it's going to be all about dividends. I mean, almost all retail investors who own banks are in it for the income. And
And the
ultimately,
buybacks.
they're looking at commentary and ratios as an indicator of how tight is cash flow going to become, and will it be a risk to potential dividends down the line and dividend growth, etc. So I suppose that's where a lot of our retail market listeners will be focused. Is we don't want to stay in these stocks and wait for the next big cut, because inevitably they will cut at some point down the line, because as you say, they're classic cyclicals.
Yeah, will be very interesting. It will be very interesting to see what HSBC does next week. Comes out on Tuesday. Now that's actually been the best performer. That's up 15% this year. But when you think about it, HSBC, it's not your classic UK bank. Most of its exposure is to China and Asia in general. So that's maybe why. But I mean, even they have said, George Elhedery was at a conference in Asia recently and said that, they're not unaffected by this just because they're not really exposed massively to the UK or Western Europe. They even have direct exposure to the Middle East through a stake in a Saudi bank. So that will be very interesting to see how those play out. You've
After
actually
such a
got
busy
more
weekend,
tech.
I mean, you could probably do
Well, you've got more tech
stiff
coming
glass
up,
of
haven't
Johnny
you?
Walker. Yeah, that's where James comes in. Johnny Walker announcing next week, James.
Yeah, that's right. And another company that cut the dividend actually, so sort of harking back to that, received a bit of a boost this week when Donald Trump lifted the old tariffs on whiskey after a chinwag with King Charles. But the results are out on Wednesday, the Q3 numbers. Consensus is looking for a 2.3% drop in organic sales. So they're finding the going really tough. And then on Saturday, we've got the Berkshire Hathaway annual meeting, the first that Greg Abel will be presiding over. I suppose the topics up for discussion will be that 370 billion cash pile that Berkshire's got, and perhaps any thoughts around the Apple stake as well.
James, interesting when we're talking about Diageo. I just wonder, Q3 results, they're not particularly common in the UK. My experience of companies that do quarterly updates is the Q1s and the Q3s tend to be fairly thin on actual numbers. Is that normally the case with Diageo?
Yeah, I think you're right, and it will be, I think, reporting for the 9 months. I think so. It's that sort of thing. But obviously, they'll be reporting on those numerous headwinds they face,
Yeah.
including changing drinking habits, tariffs, weight loss drugs, inflation impact on the consumer. So a very interesting report. We'll be keeping
So
an
it's
eye on.
more likely to be commentary led rather than numbers led.
I think so. And of course, they've got Dave Lewis in charge now, the ex-Tesco boss.
What's his name?
Dave Lewis.
Drastic Dave, isn't it?
Drastic Dave, yeah.
What
We've got another busy
Steve,
week
you've
next
got
week.
ARM, haven't you?
But yeah, got another busy week of tech earnings next week as well. And the one I think is worth pulling out and pointing out to our readers is a name that's probably familiar to a lot of experienced investors. ARM Holdings, that used to be 10 years ago, used to be listed on the FTSE 100, and it was a brilliant story. Got taken private by SoftBank. Long story short, ultimately it's got 10% of the companies now listed on NASDAQ. Key questions here, again, not really about the quarterly reporting. Of course, execution matters, but it's going to be how this chip design company, remember, it doesn't make chips, it just sells designs, how this chip design company fits into the wider AI ecosphere and what its plays are. One of the interesting debate points has been about it might actually start manufacturing chips itself. Now, this would be a massive departure and would involve a huge amount of capex. So something to definitely watch out for is, are there going to be any talks about moving away from the designs concepts and architecture only and moving into manufacturing chips, which seems like a little bit of a departure.
We've also got another special coming up next week, haven't we, Steve?
Yeah, that's right. It's JP Morgan Asian Growth and Income. And James and I'll be sitting in on that, and it'd be a really good chance to get to scale about how Asia is pitched at the moment. I mean, growth and income are very popular topics with most UK retail investors, but Asia's seen by many people as a real growth part of the wider economy. So it'd be interesting to gauge, how they feel local markets are doing. China, South Korea, Taiwan, Japan. So yeah, I'm looking forward to that one.
Yeah, nice. Well, that wraps it up for us. So make sure you guys tune in next Tuesday for that, JP Morgan Asia Growth and Income. We'll wish you a happy long weekend and we'll see you soon.
Yeah, happy May Day, everyone.
Cheers.